welcome to our roundtable. As the Executive Director for the Canadian Blockchain Consortium, I just want to thank you all so much for joining us at today's roundtable on the Growing DeFi Universe. So when our consortium was started about 4 years ago, blockchain and cryptocurrency were a pretty relatively tiny part of the technology sector. And in the case of decentralized finance, the understanding of this technology was still pretty foreign to the traditional finance sector. So all across Canada, we are seeing this widespread predictions that decentralized finance is the basis for the next generation of our economy. And we're seeing a boom in this growing universe of innovative digital assets. So for this new economy to succeed, regulators and industry need to collaborate on solutions to some of the top challenges to ensure legal clarity and a safe market adoption for the DeFi products and services. With the rising investment profile of crypto and digital assets and accelerating adoption across the world, few topics are as important to reimagining Canada's economic future. Our growing DeFi ecosystems are beginning to integrate with conventional finance and require standardization, government support, and new levels of security to fully mature and stay competitive with other global innovation hubs. Our consortium is here to support uniting industry experts across legal, technical, and financial spheres. And our Fintech Committee's virtual roundtables that are currently being held quarterly are helping to shed light on important questions that are impacting this emerging market so that we can help provide essential guidance to our Canadian regulators on building pathways to a strong, prosperous, and safe DeFi economy. But we really are just at the starting gates of this global financial revolution that's going to transform how we understand value, conduct transactions, as well as acquire capital. And digitization has the power to make investments lower cost and more accessible to a wider range of participants. So the kind of collaboration that we're seeing right now in our virtual think tank with our committee is going to help us maximize these economic benefits while minimizing the risk to both catastrophic collapse like the ICO bubble of 2018 and countervailing risk of lagging behind the rest of the world in this accelerating digital transition. Of course, our consortium couldn't do or achieve these goals without the valued support of our members. We are a volunteer organization and we rely on our industry and technology partners to help us keep doing the work that we're doing to move Canada's blockchain and cryptocurrency sectors towards a more prosperous and safe era, one that will hopefully have a really positive, increasingly large impact on our overall economy. So today we have attendees from organizations such as IROC, securities commissions all across Canada, FinTech, OSIF, et cetera, that are in attendance and are here to listen to the dialogue, but will not be providing direct comments. If they choose, they may ask questions to our group during our Q&A period. I would also like to note this meeting is being recorded and will be available to the public via YouTube. So thank you so much for your participation today. I encourage anyone interested in learning more about our organization and projects to visit us at canadablockchain.ca. And we really look forward to having this amazing discussion. So I'm about to hand it off to Eric Christie. He's our moderator for today. He is the co-founder and CEO of Badali, a financial infrastructure company that uses blockchain technology to provide better, cheaper, and more transparent financial services. He holds a bachelor's degree in computer science from the University of Calgary. Eric has been building software and distributed systems for over 15 years and previously spoke during the World Economic Forum on the future of money and has achieved the standing committee of this on industry, science and technology in INDU in the House of Commons on Canada's response to the 2019 pandemic. So Eric, I'll leave it to you.
Thanks, Kalea, for the wonderful intro. And for those of you that aren't familiar with Kalea's background, she is the chair of the Canadian Blockchain Consortium and executive director. She's also part of the Canadian Blockchain Association for Women and is an accomplished speaker and co-founder and CEO of Absolute Combustion, where she's spent over a decade successfully designing and developing groundbreaking clean tech solutions for multiple industry sectors, including the oil and gas and aviation space. So proud Alberta entrepreneur for sure. I want to thank everybody for taking the time today. We have amazing panelists that are joining us. We're going to, in terms of agenda, quickly, I'll give a DeFi overview to kind of catch everybody up to speed. And then Andrew Kigel is going to follow that up with expansion on some of the real world implications that they're seeing. We'll do a brief question period in case people have questions, because Andrew has unfortunately a meeting at the top of the hour. So I would like to give him the opportunity to field some questions, and then we'll jump right into panelist discussions with some of the prepared questions that we have, diving a little bit deeper into DeFi. So I guess the first would be jumping into DeFi and what is it? So DeFi, or decentralized finance, is really a new emerging ecosystem of financial products that range from peer-to-peer payments to lending to capital pooling, with high returns typically as an incentive alignment mechanism. They all tend to make really heavy use of smart contracts, distributed ledgers, and crypto assets, largely because of the security, but as well as the programmability of these assets themselves. It initially gained traction on Ethereum because Ethereum was the first prominent blockchain to support all three of those technologies combined. The first primitive DeFi use case that emerged in 2017, as Kalea alluded to, was the global crowdfunding via the infamous ICO, or initial coin offering market, where startups could sell crypto assets, tokens for other crypto assets such as Ether or Bitcoin. However, over the last 2 years, DeFi has quickly grown in scope and proliferated to other distributed ledgers with an estimated market cap of $136 billion if you exclude Ether, the native asset of Ethereum itself. If you included Ether, it's significantly higher. Some of the new forms of DeFi that have emerged have been yield farming, where users are able to earn very high yields on their crypto assets by providing risk capital to early stage projects. This is typically done by staking, in quotes, these crypto assets to jumpstart network or platform liquidity, align incentives, and provide risk capital that is put at stake to secure a network against malicious activity. The mechanisms at work are not that dissimilar from a venture debt or a public bond-like structure that we see in traditional finance. Another prominent DeFi solution that is developed is the concept of algorithmic stablecoins, which aim to either peg to a particular asset, primarily US dollars in today's environment, or constant purchasing power by algorithmically adjusting supply and demand curves based on interest rates and asset supply. Notable projects in this area include Maker's Dai, Olympus, Celos, CUSD and CEuro, and RAI stablecoin, spelled RAI. Finally, we've also seen a proliferation in market lending solutions, marketplace lending solutions. As with many things in the cryptocurrency ecosystem, the nature of what constitutes being decentralized is really a continuum, and we see a broad swath of actors in this part of the sector in particular. At one end of the spectrum, we have businesses like BlockFi, Celsius, or Ledden here in Canada that are more like traditional lending broker and enable people to earn yield on their crypto assets by lending those same assets out to borrowers. While at the other end of the spectrum, we have platforms that act more like a global cooperative of anonymous or semi-anonymous members that are bound together by governance tokens and a patchwork of tools. Examples of this might be SushiSwap, which is a decentralized exchange, or Olympus, which is sort of a bond issuance platform for decentralized networks. Collectively, in structures like this, the members work together to publish smart contracts to distributed ledger networks such as Ethereum, Solana, Celo, and others, and build the front-end user interfaces to interact with these smart contracts. In many cases, product decisions are determined by governance token holders, which can be quite a transient group of people. So with that as a quick crash course in DeFi, I'd like to turn it over to Andrew Kigel to dive deeper into some of the DeFi use cases, risks, and some of the economic potential it possesses. And for those of you that don't know Andrew, he's an accomplished executive with leadership experience in Canadian capital markets, corporate governance, and entrepreneurship. He's currently the CEO of tokens.com, which is a publicly listed crypto staking entity, and was the co-founder and CEO of Hut 8 Mining, one of the largest publicly listed Bitcoin miners in the world. Prior to that, Andrew spent over 18 years at GMP Securities, now Stifel Canada, in investment banking, and his most recent title as a managing director and head of real estate banking. So with that, Andrew, I'm going to turn it over to you.
Yeah, thanks, Eric. That's a good overview. I think you took a lot of my stuff, but I think one of the things I'd like to say is I started my career in finance and capital markets. And one of the things in working at an investment bank and in banking for 20 years is, always recognizing the importance of regulation and also being cautious of unintended consequences of overregulation. But in terms of DeFi, maybe just to take a step back, about 12 years ago, Bitcoin was developed, and Bitcoin, while quite innovative, is not very dynamic. It was a little bit like the first email that was sent, or maybe the first phone call. As the amassing of power required to validate blocks on the Bitcoin became more prominent, and I think the initial use was something that people could just do crypto mining off their computer, new technology was developed called an ASIC chip, which stands for Application Specific Integrated Circuit. And it's basically a chip that moved Bitcoin mining and validation of these transactions from being a hobbyist activity to something that has moved to an industrial scale. And when I was an investment banker, I sort of saw this coming and started one of the first public Bitcoin miners, which is now close to a $3 billion entity. One of the, I think, other unintended consequences of Bitcoin, though, was that people were looking at it and said, it's not very dynamic. What can be done here to enhance it? And I think that's where Ethereum came in a few years later, in that it's a dynamic, programmable language within the cryptocurrency space. To provide an analogy for you, and this is one that seems to resonate with people, but think about the operating system on your phone. You might have iOS or Android, and there's different applications and apps that can be used. You can go to the Android store, you can go to the Apple store, and there's different apps that are built on these operating platforms. And really a sense of how you want to think about DeFi is there is this programmable operating system, which really the first one was Ethereum, which was an offshoot of Bitcoin, that can be programmed with these smart contracts or conditions. And this really paved the way for decentralized finance and where we are today, which is financial services that one party can conduct with another without the use of an intermediary like a bank. And certainly that is an area that regulators need to keep a close eye on. Traditional systems like a bank would have a centralized authority and the ability to sort of monitor everything that was going on. In decentralized systems, decentralized finance, the consensus or the validation is really spread amongst a whole bunch of different people that are really getting rewarded for doing that. It's really the opposite of the way a bank might work. As Eric mentioned, this is an area that's grown really, really quickly. It went from really being nascent industry, call it at the beginning of last year, to now having close to $140 billion deposited by somewhere the estimates between 6 and 7 million users who are transacting with each other on these applications, primarily built on the Ethereum operating system, without the need of a bank. And it's a trustless system because you can't pick up the phone and say anything. It's all run through technology and preset algorithms. And I think that is what is attracting a lot of people. It's a way for many people who might be traditionally have the inability to access a bank or don't want to use a bank. You can do this. The other point I'll make here is this is a really hot area. And again, this is going to be a challenge for regulators. Apart from the $140 billion that's been devoted to the space, there's been billions of dollars raised by Silicon Valley and Wall Street to create these applications. And so although they sort of started as these projects, they're becoming more and more sophisticated. This is big, big business and some very deep pockets that are sort of betting on the delivery of financial services through technology instead of through a centralized authority like a bank or an exchange. I've often said before, this is a little bit like a tidal wave of innovation headed towards the regulators. I don't envy the role. There's really just so much going on. So it leads to the question, why would anybody use DeFi instead of going to a bank? The reasons are this: it's faster, it's less costly, and the rewards or the income potential for the user are higher. And let me give you some examples, some real world examples. As a person who's been running a business, I remember when I started Hut 8, and we needed to wire money to the city of Medicine Hat, Alberta, and we needed to get it there within a few hours to meet certain regulations. We call up the bank, and the bank is like, great, you need to get somebody down here. It needs to get to us before 3 o'clock. And if it comes in after 3 o'clock, we won't process it till the next day. And then once you do get it to us, we'll try and get it to wherever it's going within 24 hours. And I think we ended up having to pay, I don't know, $50 or something to transfer other things. I saw someone talking about Lightning Network, but and I can talk about, I only have about 13 minutes left. But when you think about the DeFi world, and Eric touched upon stablecoins, you really have the ability to move capital around very quickly for very cheap. I remember showing people this in different instances, auditors. I moved $30 million of Bitcoin around the world in about half an hour, and it cost me $1.34. The banks just don't have the capacity to do that. International remittance is another thing. I was born in Santiago, Chile, and sometimes I'll gift some capital to my cousins there to help them out. The SWIFT code system is quite antiquated. You have to go to the bank. It's pen and paper focused. I got to provide the bank where it's going, a whole bunch of different coordinates. The money gets deducted. I pay a pretty large fee. I think it's 3 or 4%. The money disappears for 5 days, sometimes 6 or 7. And then you hope it's going to appear in the bank account it's intended for. And by the time it arrives, there's another 4 or 5% that's been deducted through all the intermediaries along the way to get there. Again, that's old school technology. That's, horse and buggy. That's physical delivery of mail. There's better technology out there today. And this is why people are flocking to DeFi. From the regulator standpoint, it's a massive challenge. How do you know the money being transferred around has cleared AML, KYC? How do you fact check where the money is going? There's certainly a lot of legitimate players out there, but for sure, just like any form of new technology or currency, there's going to be people that try to exploit it. Other uses. Borrowing and lending are one of the biggest use cases in DeFi. And let me explain what this is, because I use it myself. If you deposit your money in the bank these days, your interest rate is pretty close to 0. If you're in Europe, they actually have negative interest rates. You have to pay the bank money to deposit your stuff. There's actually $9 trillion deposited in German banks where they're paying interest to keep it there. So what does that mean in the crypto world? Well, I can go out and let's say there's a person that owns $1 million of Bitcoin and says, I think Bitcoin's going to continue to go up. I don't want to sell it, but I would like to use it as collateral. You can deposit it amongst these technology-driven systems, deposit your Bitcoin and borrow 50% against it. So I can borrow $500,000 in US dollars or Canadian, whatever the equivalent is, and I can use that. There's terms and conditions there, and they're governed because they're built on top of the Ethereum operating system, and the rules are met and followed. My ability to borrow out of that might be 5 or 6%, and the person on the other side who's doing it is going to collect 5 or 6% for providing the money for me to borrow. And so this is part of the interest level and why there's borrowing and lending that's occurring. The other key area that's going to be huge, and again, you think about the trading systems. Right now, it's T+2 to settle a stock market trade, and it can only happen between 9:30 and 4 o'clock in most major markets in North America. People have an appetite to do more than that. And I think if you see where technology is going, I predict in 2 or 3 years, there's going to be trading that you'll be able to do 24 hours a day, 7 days a week, all through technology. And this is all going to be enabled through what I believe is decentralized finance mechanisms. The other piece I would want to leave you with is I think DeFi is the main contributor to crypto going green. And I'll elaborate on that a little bit. When Bitcoin was developed 12 years ago, I mentioned that I think it was an unintended consequence that the technology was going to start growing so quickly that it was going to go from a basement activity on your computer to creating these massive industrial mining farms, which really consume a lot of energy. The new system that's used to validate blocks for DeFi is called proof of stake or staking, where instead of amassing processing power, you're actually amassing the actual unit of the token you're staking. I think that's a huge advantage because number one, it's green. There's 99.9% less electricity required in that process. But I think the other piece is it can process more transactions. And so traditional crypto mining, and somebody mentioned Lightning Network, which, Lightning Network has been around for a few years. It sort of has not gone mainstream to process more, but traditional crypto mining can process about 15 transactions per second. Visa, MasterCard can do 30 to 40,000 transactions per second. And in staking, you are able to process 100,000 transactions per second without relying on electricity or hardware use. Instead, it's done through ownership and consensus of the people who are validating those blocks. It's a little bit like having a stock or a common share in a company where you use your votes in order to allow things to occur that are meant to happen. Staking is not lending. Custody remains with the staker. However, there's a payout that's made in additional tokens for that person who's providing that service. So I think that's part of a big driver of what's driving things to go green. In terms of maybe how I'll wrap up is I'll talk a little bit about regulation because I don't have a ton of time left. But what I would say is I don't envy the role of a regulator in this space. There's a fine line, I think, between over-regulating and scaring people away. And I think we've seen examples where you have what I would call legitimate players who are exchanges or traders that really get frightened out of dealing in Canada because some of the rules are just too onerous. And what I think happens in those situations is that it can lead to more cases like Quadriga. There's a fair amount of what I would call fear of missing out in the crypto space, that people just want to get in and they hear from a friend and this and that. And you can end up getting involved with people who are bad actors and want to take advantage of people who are really just looking to make some income. I think where I would like to see regulation go is that the regulators will work with the larger players in the space to set up rules and boundaries, to understand how it works and lay out a framework that should be somewhat onerous, but not prohibitive. And I think that is what will sort of keep out what the bad actors are, who are trying to slide underneath to take advantage of people and allow the people that have legitimate businesses and want to enhance the DeFi and crypto and blockchain ecosystem to flourish. And so maybe with that, I'll end my chat on what DeFi and my view on it. And I can, Eric, I'll turn it back over to you, and I'm happy to answer questions.
Yeah, thanks, Andrew. If anybody has questions, I know Carl Wilding submitted one specifically around, whether I think these cryptocurrencies could disappear depending on, especially DeFi ones. I think, adding commentary there myself, I think that's a risk with all of these, given just how early the stage of this technology is. But I mean, you want to parlay that into a larger question to you, which we'll touch on a bit with the other panelists as well. What do you think are some of the major risks of DeFi today?
Well, a lot of it has to do with regulating the bad actors. And so, as I said, you have these new operating cryptos like Ethereum. I saw a note and mentioned Solana. There's Polkadot. There's Binance Coin. There's a lot of them out there. And really, it's like the same types of things that the Apple Store might have to do to regulate the apps that are built on its operating system. You want to make sure that these things pass a certain set of rules, they've met a certain set of boundaries and regulations, so that people are protected when they use them.
So, I mean, to follow that up, I think that's a great point. But when this technology is, anybody anonymously could launch something, and we have this FOMO, and people looking to get yield that are in some cases, claimed at hundreds of thousands of %, which is, kind of absurd. How do we actually protect consumers? Do you have any thoughts about how we might go about something like that?
So, I mean, that's a complicated question for me to answer in 4 minutes, Eric.
Yeah.
But what I would say is, I think you have to look to sort of maybe the early days of the internet and different things. So the nice thing about dealing in crypto is if you're dealing with a proper algorithm that's built with smart contracts, the protections are somewhat built in. That's a little bit of it being a trustless system. So if I'm depositing $1 million of Bitcoin and I'm asking for 50% collateral loan, and I don't meet the repayment terms on that, that person has the ability to access that collateral, okay? So the algorithm provides the protection on the counterparty risk. I think where the risk lies is if somebody comes in and says, yes, I've deposited $1 million worth of Bitcoin when they really haven't, or if they've tried to deposit that in several areas. And so that really just relates to creating these boundaries and rules for people who are designing these applications, the DeFi applications, to follow.
Yeah, so I guess maybe one final.
People trust places like DeFi and PancakeSwap and Sushi. Like, there's certainly people out there, and like I said, I deposit my Bitcoin, and I have a lot of faith in the groups that I'm using. I do my due diligence, but I'm sure there are some bad actors out there who are trying to take advantage of people. My fear is that if the sector is over-regulated and the good actors shut down, you might have the people who just want to take advantage, who try, like the Quadrigas, who try and come in and take advantage of people's fear of missing out.
Right. Yeah, and I think, like we mentioned already, there's a swath of decentralization. I think a lot of the stuff you're talking about is really, more smart contract driven as opposed to more centralized brokers that are still leveraging this technology, but still have a more traditional structure, which obviously there's, I think, probably a clearer path to regulatory oversight. A quick answer or quick question to you before you have to jump would be, do you think the role of the regulator changes now where maybe, they're stamping or approving or auditing smart contracts themselves?
I think that would be cumbersome to the system to do that. The algorithm is there to do that. I think where the regulators need to come in is to some of the same rules that they might apply to a bank. So it might have to do with the amount of deposits, the type of coverage, leverage ratios, things like that. I think I remember when I was running, in the crypto mining space, and somebody said to me, well, maybe we should come in and approve every block that's approved. I mean, that's an impossible task. And what that would lead to is over-regulation, where we would have just picked up the operations and moved to another country. You do not want to stifle innovation in what is going to be a very important area, I think, for Canada and around the world. You want to find ways to work with the people in the space to not create a system that is too onerous and will have them relocate elsewhere where they can do it.
Okay. Thanks, Andrew. Thanks for the commentary. I appreciate it. And I appreciate your time.
I apologize that I have to run off, but good luck, everyone. And I can be reached, I'm sure, through some of the hosts if they want to contact me.
Thank you very much. Okay. With that, thank you again, Andrew, for the commentary. Appreciate your perspective as somebody who's kind of worked in various aspects of the space, I think, and come from traditional finance. I think it's very important that we're including diverse perspectives and opinions on this. Next, I'd like to move over to our amazing panelists that we brought together. First, I guess starting off with Marta Belcher. She's the General Counsel of Protocol Labs and the chair of the Filecoin Foundation and Filecoin Foundation for the Decentralized Web. And she's a special counsel for the Electronic Frontier Foundation. Marta is the General Counsel and Head of Policy for Protocol Labs. She also she helped pioneer some of the cryptocurrency Sorry, my apologies. Marta is a pioneer in the cryptocurrency law and has spoken on the topic around the world, including in the US Congress, European Parliament, New York Senate, the OECD, and in Davos during the World Economic Forum as well. She's drafted amicus briefs in the US Supreme Court, US appellate courts for high-profile public interest organizations, including the Electronic Frontier Foundation and the Center for Democracy and Technology, Public Knowledge, the Cato Institute, the National Consumers League, Project Gutenberg, and the Blockchain Association. So Marta's definitely had her experience in a bunch of the regulatory efforts. She's been recognized twice by the Financial Times Innovative Lawyer Awards and was named to Law 360's list of top attorneys under 40. And of course, number 18 on the Crypto Weekly list of most influential women in crypto. So Marta's a powerhouse. So very happy to have her. We also have Jeff Bandman, who leads Bandman Advisors, which is an advisory practice helping clients ranging from governments to global firms to startups meet strategic innovation and regulatory challenges. He was the founding director of Lab CFTC and has been a pioneer in regulatory innovation, and with a specific focus on blockchain, crypto asset law, regulation, and policy. He's a co-founder and board member of the Global Digital Finance Policy Initiative and leads its regulatory engagement globally, including the GDF Regulator Forum, which is a quarterly regulator-only roundtable. He teaches law, policy, and regulation of blockchain and crypto assets at the University of Nicosia's Institute for the Future. He's been selected by the European Securities and Markets Authority to the Consultative Working Group for Experts for ESMA's Financial Innovation Standing Committee. He's got a long track record here. He's also been appointed as an expert to the expert panel of the EU Blockchain Observatory and Forum established by the European Parliament and European Commission, and has advised the government of the Republic of Cyprus on new distributed ledger technology legislation and performed national risk assessment for Cyprus under new international FATF requirements and methodologies with respect to money laundering risks for virtual assets and virtual asset service providers. So, and he's also advising the CySEC Securities Commission on new AML directives for crypto assets and VASPs. So he's got a lot of experience, obviously, in Europe, but much more broadly around regulation and how it's impacting AML and potentially legislation. Next up, we've got Lucia Gallardo. She's an award-winning Honduran serial entrepreneur that bridges emerging technologies with strategy and international development. And she's the founder of Emerge, which is a socio-technology solutions development lab that's offering impact as a service. So Emerge works with global enterprises, governments, public institutions, organizations, and communities to solve complex problems and drive impact-centric digital innovation at scale. She also co-founded Donna Un Libro, an educational foundation taking on taboo issues such as undocumented immigration across Central America in youth-friendly ways, and she's joined the advisory boards of various groups to help drive impact technology strategies. She also co-chairs the International Expansion and Innovation Councils at Women Entrepreneurs Global, which is a full-stack startup innovation studio for female founders. And in her spare time, she sits on a few boards for an array of meaningful issues to her, such as the board of directors, the Rainforest Partnership, and the Caribbean Blockchain Alliance, as well as on the advisory board of several early stage ventures founded by women, immigrants, and other undersupported groups. She's currently experimenting with decentralized autonomous companies, so DACs. Other form of that would be considered maybe a decentralized autonomous organization, so DAOs, if you've heard that term. Impactful NFTs and autonomous IoT-based data collection. So Lucia is an MIT Innovator Under 35, and her work in digital identification has been nominated for several awards, including the Global SDG Award. Lots of impact experience there, but as well as a broad swath of blockchain experience and seeing impact and the potential in Latin America and the Caribbean. You've already heard from Andrew, so we also have Alex McDougall. He's a seasoned investor, speaker, and advisor, specializing throughout the full life cycle of companies, from early stage to multinational. He started his career as an investment banker at Bank of Montreal, and Alex led multiple projects and teams across BMO capital markets, including fintech, M&A, financial institutions. After leaving BMO in 2018, he co-founded Bicameral Ventures, which is a platform focused on interconnected investing, so specifically blockchain, interoperability, data and identity, self-sovereignty, and Web3. And then Alex joined the Stablecoin team in Q3 this year as president and COO to launch the VCAD, the world's first bank-issued stablecoin, in collaboration with VersaBank. And Alex has spoken at CES, Consensus, World CryptoCon, Coin Agenda, and has written for CoinDesk, Toronto Star, and other publications. So I want to make sure I've got everybody because we had a long list with long bios, and I did. So go me. I want to jump into some of the questions that we have, because this is obviously, DeFi is a very nuanced topic. There's a lot to cover. We only have so much time to cover some of these aspects, but I think first and foremost, now that we've heard from Andrew about some of the potential economic implications and use cases, what are some of the leading standards, potentially around verifications and disclosures that you're seeing or that could be used to keep DeFi safe and protect DeFi users? I'll let somebody go first if they want. Otherwise, I'm going to pick on maybe Jeffrey, and then give everybody kind of a round, an opportunity to speak.
Maybe I can jump in and just give a little bit of a started answer for that, and turn it over to Jeff. I think standardization of such a novel and nascent technology is a fascinating endeavor, and it's almost like trying to put standards around something like the tax code that is so multifaceted and challenging and ever evolving. And a lot of the standardization and a lot of kind of the standards and disclosures are going to be based around wall clock time. What platforms have been out there? What platforms have stood the test? What platforms have been sort of attacked over and over again and defended themselves successfully? And so it's DeFi is such an interesting space in how interrelated everything is, and we'll obviously get into some of those nuances in time in some of the other questions. But I think we'll talk a little bit on this panel about certain types of disclosures, certain of the specific standards. But it's such an interesting space and an interesting area of technology to be able to even put standards on at this point, given how novel everything is. I mean, we have 3 or 4 platforms that have been the sort of the well-known industry leaders for a period of time now, but even those are kind of 2+ years old at this point, and have had their own issues recently. So I'm excited to hear the rest of the panel's take on this of how we put standardization and how we put sort of things that are consistent around something that's changing so rapidly on a day-to-day basis, and changing by design as well.
Yeah, Jeff, do you want to take that?
Yeah, sure. Let me jump in. It's a great question, and there's a lot of approaches to regulation, and and the comment was made earlier, suggesting suggesting maybe the 2017, 2018 ICO wave, was that a chapter of DeFi or decentralization or not? I guess there can be it certainly was an earlier iteration, and we're seeing today a lot of new projects and creativity, and as I'm going to make kind of fundamentally 2 observations. One is that going back to 2017, 2018, the policy organization I co-founded was actually initiated as a result of that first wave, because we saw both the potential for enormous benefits for consumers, for economies, for economic efficiency and innovation, for financial inclusion. But we also saw both kind of risks that were not necessarily understood by the people using those platforms, and that were, and it was complicated, and there was not kind of a single harmonized regulatory approach. And so the approach that we took in global digital finance at that time was to convene kind of an international community of market participants and service providers, and with regulators as observers and weighing in, and we developed kind of codes of conduct and sets of principles. We put together a taxonomy to actually start to have a common vocabulary. And one of the things about crypto is that there's constantly evolving and new vocabulary. Like the metric, like for example, one of the major measures of DeFi is something called total value locked, which is how much is sort of put into some of these DeFi smart contracts. It's a completely new word, right? Or a new use of, I guess, locked is an old word. So, it's important to have common understanding of these terms. And, I think, a good starting point that the industry can do in collaboration with kind of users and regulators is to start to develop kind of codes of conduct and principles. And in fact, GDF is starting, is starting that work now. And I would invite, everybody, on the panel and interested observers to join that work, which will be visible and transparent, because I think, in some ways there are parallels to that. The second point I want to make is that it really to concur my fellow panelists that, we use the term DeFi, but, DeFi it's not monolithic. There are so many different business models and, different types of businesses. So it might bear resemblance to lending, though people with so-called lending platforms probably wouldn't agree with that. There's trading platforms, there's all kinds of other things. So it's not monolithic. And these things are evolving very quickly. So I think in terms of a regulatory approach, something that, for example, the CFTC, we have a statutory basis, but our overall regulatory framework is principles-based regulation. And I think in thinking about, how to deal with an area that's as dynamic and evolving as DeFi, and saying, well, what is the best regulatory approach to apply? No one is going to suggest, well, this is new, so there should be no protections and just nothing should apply to it. Nobody's going to say that. And particularly when you're, thinking about, potentially, vulnerable consumers and retail investors. And here in DeFi, you have both retail and institutional, right? I mean, there's a general feeling that institutional, is maybe better able to understand the risks and protect itself. Although, 2007, 2008 suggested maybe not quite so much. So regulation has imposed greater risk controls there. But I think, from as we're thinking about, kind of standardization, are we going to kind of lock in something before the technology has really evolved? And from a regulatory approach, and it's my understanding, and I'm not a specifically Canadian regulatory lawyer, but I think that there are certain things that I would say are maybe very hard coded in terms of investor protection, but there is scope to have kind of principles-based regulation. There's also kind of sandboxes and innovation hubs, in Ontario, in Quebec, and in British Columbia, and perhaps others. Ontario just launched their tech lab. So, I think also interacting with those kind of regulatory innovation areas combined with really focusing on, is there a way to have principles-based regulation, I think will really allow this to flourish while protecting consumers and market integrity.
Hey, Chef. I see Lucia's got her hand up, so turn it over to you. I want to hear, your take and maybe riff off of what Jeffrey was just saying.
Sure, it's one of my favorite features in Zoom, the hand raise. It makes me really happy when people use it. I actually am really thrilled that Jeff brought up the fact that DeFi is used as a blanket term and is not in fact monolithic. And I think that is really the key to unlocking how to understand the regulatory needs and requirements that the space could use. Stepping back maybe for a couple of the people in the room, if you're thinking about something within the DeFi space, you really want it you want to understand if it directly mediates the transfer of value, because if it does, then we are still on this DeFi train. And if it's not, then you're looking at something like an auxiliary service that, doesn't really need that regulation. If you're then looking at something that is settled on a public blockchain, then at that point, you're still on the DeFi train. And if not, you're looking at a digital, banking solution, and therefore it has its own set of requirements that is constantly changing as well. Thirdly, you want to be looking at assets that can't be unilaterally taken or seized or transferred without, permission and consent. And so if they can be, then you're looking at a custodial solution, at which point that requires its own set of requirements and regulation. But if you're still, looking at something that is non-custodial, you're on that DeFi train. And then again, we go into all of these different use cases. A lot of the questions that have been popping up in, my inbox lately is how to regulate NFTs. But NFTs are just a representation of an asset and the chain of custody that belongs to that asset. So if you're too busy looking at how to try and regulate NFTs, you're missing the actual real, opportunity and regulation, which is the asset itself. And regulation for a lot of the assets that are traced with NFTs right now already exist, like, within art or so on and so forth. And so realistically speaking, if you want to take this approach of, okay, we want to create good policy and regulation, we need to look at the endpoints, the on-ramp, the off-ramp. We want to be looking at the messaging and how, these products are marketed to consumers in order to better protect them. We want to be looking at, how that the data and the PPI is actually managed. Is it custodial, non-custodial? Where is the payment settlement taking place? How is it taking place? How much of this is open source? How much of it is not open source? And so when you start looking at the intricacies of all of the components and utility that make up the DeFi space, I think that's where you can really see the opportunities for protecting consumers and creating appropriate regulation. If we continue to talk about it as DeFi and regulating DeFi, I think we're going to make very little headway in what we're able to do to protect consumers.
Yeah, I think you bring up a really great points, really great questions to ask as well. The one thing that I would also add is the governance. I mean, I think, so let's feel free to dive deep into this topic, because I know, having spoken with a bunch of the regulators that are listening on the calls, that they are quite versed in the high level of what DeFi is. So I think some of the risks, when we talk about some of those is, specifically when we're talking about decentralization and we have a platform that legitimately is a smart contract and has been, peer reviewed and deployed, which could still have bugs in it, so there are those risks. We are starting to see developers put those things out there when they're publishing and saying, hey, please don't use this, but then people use it anyways because there's this opportunity for financial gain or for more efficiency or more open financial access. And so I think this is the interesting world we live in, where we're publishing, people have the ability to publish things openly and they can be used permissionlessly, right? Even if you make those disclosures and claims. And then on top of that, even if something is necessarily published to an open ledger and isn't being mediated by some sort of intermediary or custodian, we now have who governs the contract changes, who governs, and then in a lot of cases, these are governance tokens, but how is that distributed? Because in a lot of cases, we have venture capitalists that have invested in these governance tokens that own a large stake, or we have, potentially other actors that have purchased them up on open markets. So I can see Marta smiling, so I definitely want to go to you and hear what you have to say.
Sure. So couple things on this. I think, well, first of all, I should say I'm a US lawyer, so apologies in advance for the US-centric view. But I do think that it is sort of a myth that this space in general is unregulated. I think, first of all, the on-ramps and off-ramps, at least in the United States, where people are buying and selling and custodying cryptocurrencies, particularly, where you're sort of going from cryptocurrencies to fiat, to US dollars or another fiat currency, are really heavily regulated. So in the United States, these are chartered banks for trust companies, or their state licensed money transmitters. They have minimum capital requirements. They have to post bonds. They have yearly examinations, and they are financial institutions under the Bank Secrecy Act. So they have to register with FinCEN and do know your customer checks and share details of suspicious transactions. And I think one really important thing that's to keep in mind is, just from a consumer protection perspective, if someone's committing fraud, it doesn't matter whether they're committing fraud using cryptocurrency or the phone or email or a pen and paper, right? The technology doesn't matter. Actions can be taken by a variety of actors. In the United States, that's the CFPB or the SEC or state attorneys general, in addition to private causes of action. And so, in other words, in many instances, with many of the concerns that folks have in this space, we really can and do already apply existing laws and regulations in this space.
I completely agree. We have the same thing happening in Canada as well, and Alex and I can attest to that. And we're seeing that happen elsewhere. I think the question marks right now is, like, with all of the various diverse activities and the broad spectrum of what is fallen under the umbrella of DeFi, is what should the regulators regulate, and what can they regulate even functionally? And does the role of the regulator actually change? I'm here in Bermuda, and I had this discussion with now the CEO of the BMA last trip, and having, Craig Swan is a rare breed in that he writes his own smart contracts to better understand how this technology should work, and he's the head of a regulator. So the discussions that we had was, maybe to what I alluded to, that maybe regulators end up creating sandboxing and almost acting like another auditor to help ensure that the smart contract are doing what they say they're doing. Have you guys, with your global perspective, I guess, what do you think the role of the regulator should be with, if we step outside the on-off ramp? Do you think there's any way for them to regulate? And if so, maybe how? Or are you seeing things happen in other parts of the world that are being discussed?
Can I start on this one, and I'll let my distinguished colleagues build as well, and potentially take it in a different direction. I just want to go back to one thing Andrew was talking about as well, that's exactly in line with this, Eric. Of where sort of the risk buckets are. So I find that's a helpful way to start thinking about, okay, well, where can regulators play is really where sort of the risk bubbles up and cauldrons, for lack of a better word. And there's sort of three in DeFi, and there's, in the Venn diagram, there's a fair amount of overlap in these three, but bad actor risk, which as Marta hinted at, is very well defined of how we regulate it. Some of it is how we identify it and isolate it in DeFi world, but bad actor risk, financial risk, which is also something that we're quite familiar with regulating, and Lucia nailed this as well, of if it's a lending platform, it's not that dissimilar from an offline lending platform. There should be total value at risk, there should be leverage limits, there should be capital requirements, and a lot of these tech platforms that are built by tech people have really sort of lost that finance part of DeFi. We've really focused on the decentralized part and sort of forgotten about some of the finance pieces. And then the third part is tech risk. And some of that is, okay, we've written a contract that has a bug in it and somebody's driven a hole through this bug. It's like some of that is sort of tech risk that becomes bad actor risk, but it's not bad actor from a fraud perspective, it's bad actor from an even better tech perspective. And I think what's really interesting is some of the tech risk is actually financial risk. Some of the exploits that you see on DeFi platforms aren't actually malicious hackers. They're just power arbitrage in a really, really complex system of black and white rules that we were talking about, the interrelation. When you have a completely circular system like something like Compound, and you write the smart contract for it, it's easy to look at, not easy, but you can look at the entire black and white set of rules and say, cool, I've audited this, I think this is gonna work, let's go. Then you need, for those set of rules to work, you need oracles that have pricing feeds in them. And if there's a glitch in the pricing feed, like we saw earlier this year, the rules for Compound blow up, interrelations. You add in these flash loans that are basically allow unlimited leverage to come into a system like that, that overwhelms the tolerances. And so it's sort of this, isolating those three buckets and really figuring out where they link to each other and trying to figure out how to minimize those interrelations where the machine speed loop runs away from us, because that's really where you get these $600 million breaks where it's two machines running into each other that were never necessarily meant to run into each other, and the end result is massive value losing, where we don't have kind of the human speed to be able to step into the middle of that transaction like we would in a traditional financial institution, where we're like, no, that's not what we wanted to do, abort that transaction, please. And so I think when you're thinking about how regulators really should look at this space, I mean, there is some angle of all three of those, of trying to apply some semblance of financial limits to platforms that are doing machine speed versions of things in the traditional world, and also layering on our existing bad actor risk and our existing crime insurance and some of those things that help to mitigate tech risk that we already have in the system and structure as well.
Yeah, Alex, thanks for, I think it's brilliant. Quantifying those three different buckets is really, really important, because you're absolutely right. I mean, I'm seeing even some comments in the chat about, things being kind of a free market system, and that's almost what some of the power is in some of this. I think maybe one of the questions to ask, I'm going to throw this your way, Lucia, and you pick up with what you wanted to say even originally. If this is sort of this free market system and people kind of know the rules of the game and can actually audit it, if we're protecting against bad actor risk, but the financial risk and the technology risks are disclosed and known, do we just let the free market work, right?
I mean, that is the underlying philosophy of the technology itself, right? It's inherently saying that it is an individual freedom to be able to invest and borrow and store and earn and whatever else you want to do in ways that are freeing. And so in a way, yes, I think if we are able to create these categories of, and by the way, my original point was to add some buckets to Alex's list. I think it's a great point of departure. In considering some of the financial risks, yes, technology risks, absolutely, especially as it pertains to smart contracts. So much is being done using smart contracts, and yet the volume of projects with unaudited smart contracts is actually mind-blowing to me. And so, things like best practices in terms of how we're going to manage the oracles and the smart contracts within a project, I think is super important. On top of that, I'm looking at operational risks and thinking, how is this government governed? And that's a question that DeFi has struggled with a lot. True to Alex's point about people being obsessed with the decentralized part rather than the financial part. One of the reasons why they're obsessed with the decentralized part is a lot of the philosophy and the language that is used to talk about this space in theory. But if you really look at the decentralized space in practice, it mirrors a lot of the existing financial services, financial products, financial operations, et cetera. And we're essentially creating a lot of digital versions of this built within public chains. And so I think that because of that, we need to make sure that we're paying attention to the parallels and what is going on. And actually, as someone that specializes in financial inclusion and just general socioeconomic inclusion, I think it's honestly concerning that we're replicating a lot of what exists in the current world. And by creating some of the similar rules and regulations, we're continuing to create exclusionary practices within the DeFi space. So, there's obviously pros and cons to doing that. And I can see how much, value there is in protecting people through these kinds of requirements. But then again, there's a reason why over 3 billion people are not integrated within the formal, financial system. And so some of the things that we sort of are trying to do here is, yes, pay attention to the decentralized part, pay attention to the financial part, but also understand a systems approach and a governance approach and how that impacts people and what the shortcomings of the system have been throughout time, to make sure that as we are continuing to create standards for this, that we don't impede what the original spirit of the technology is trying to do, which is to build a freeing and inclusive system around the world. And then other two buckets I would add, aside from the operational one and governance one, I guess I would put those in the same bucket, are legal compliance. And again, we struggle here because of the requirements around identification and having about 1.2 billion people in the world without proper identification documents, and also sort of seeing the lack of interoperability and treating or being within a system, a DeFi system that is treating identification as sort of like an asset as opposed to a legal right or a human right. And the classifications for what kind of data needs to be collected for one or the other are absolutely different. And until there's more, I guess, interoperability in the platforms that are existing within the DeFi space in using identification as both an asset and a right, until that is sort of resolved and there's more reconciliation between the types of data and data management practices that need to be, it's going to be really hard to get DeFi structures working perfectly with let's call it real tangible world. And finally, I think emergent risks are really important. The market dynamics, we're looking at, sometimes flash ups and downs that might impair a lot of participation for a lot of people around the world that have less liquidity to participate in these kinds of markets. And so thinking about the environmental context and risks, I think, is also a really important bucket that needs to be factored in. But all in all, I think I would agree that that the goal is really to allow people to choose what financial system they want to participate in. And it doesn't have to be one or other. It could be, both at the same time for certain things. And that's inherently the spirit of, a free economy and a free market. And so I would agree that that's where we're trying to head. That yes, there's absolutely value in setting up rules and regulations around certain components, but really thinking thoroughly about how we're going to do that, where it's worth doing that, and also what impact that's going to have on people that continue to be excluded from a global financial system.
Yeah, Jeff, I completely agree, Lucia. I mean, I think this is the same, towing that line of opening up financial access, especially for people that are disenfranchised, but trying to ensure that bad actors and that risks are contained so that, a lot of these people who may even not be sophisticated investors understand or are able, don't get burned, right? It's it's not an easy feat. This is why it's not done yet, right? If it was easy, it would be done already. I want to turn it over to Jeff over there too. I think one of the things I wanted to add really quick is what we're seeing in Bermuda here. Part of the reason we're setting up operations here is their legislative framework has kind of laid out this sandboxing mechanism so that you can start to, under the BMA's supervision, address some of these concerns. So, ensuring whether you've got insurance, which is still a challenge in the industry. I mean, it's damn near impossible to get adequate coverage for custody and even for operational risks. So that's still a challenge. And there is some flexibility there. But I think what we're seeing in a couple of the leading jurisdictions, regulatory jurisdictions like Singapore here, and even to some extent Switzerland as well, is that there's a sandbox where there's a little bit of wiggle room, but they are focusing on some of these risk points as saying, how do you address technology risk? How do you address governance risk? How do you address operational risk? How do you address AML risk? And then, and financial risk or risk of loss. And so I think, at least as one of the Canadians on the panel, that's something that I would encourage regulators to look at, and how we can actually set up a framework to be able to encourage innovation and escalate through those kind of risk points and evaluate those, especially given that the technology is changing so much. Jeff, take it away.
Yeah, so that's great. I was going to make a couple of observations. I mean, one has to do with, and really building on kind of Lucia's observation, is that, why are people using these platforms? Is it because they, they woke up one morning and they said, okay, let me do something that's kind of more complicated and less convenient than what I normally do? It's because, there are benefits that they're, receiving, and there's something. And, I think that a lot of the time, and I've seen this in other, waves of technologies, including, like in people like myself who are sort of old enough to remember like the late 90s or early 2000s. And it was like, oh, well, it's a .com, it's an internet. And, after a while, like people don't really want to know the details of, is it on a blockchain or an internet, or, is this providing me a service or function that I can use? And is it providing something that, is not currently available in my other existing ways of doing it? And so, I think that, we'll really know when we have full adoption of blockchain or full adoption of DeFi, when nobody talks about the fact that it's blockchain or DeFi. Like people talk about using, Facebook or YouTube or, Airbnb, and they don't say, oh, I'm using an internet service that lets me, do X, Y, or Z. So, I think that's, in thinking about it, why are people using it? I think that they're dissatisfied with, some of the other offerings. I think maybe some of it is principled. I also wanted to kind of follow up on something that you mentioned, Eric, and, I sort of talked about regulatory approaches and, kind of the principles-based approach. But yeah, you talked about Bermuda's approach, and, they are an example of a jurisdiction that has, it's really quite exemplary. They've developed, bespoke legislation for digital assets. They've developed expertise at the regulator, for overseeing it and onboarding and managing it. They also have set up sort of this kind of gateway program, a sandbox type thing. And the important thing about a sandbox, for people to understand, is that it's not just taking away the goalie and letting people do everything, but it's putting kind of proportionate it's, two key things. One is, during kind of the early phase, while something's on a small scale, putting, let's say, proportionate safeguards around it. But, it's not like you say you don't have to have any safeguards. You just don't have to have, everything that you would when it's a full-blown at full scale, which lets people iterate and review with the regulator. The other thing that I think Bermuda does well and has been part of the design of their program is they think about, well, when someone's coming in, how is somebody going to come out, and sort of what's the process, because the goal of those programs is to have people start in the sandbox and then evolve into kind of in the fully regulated space. So I think that is a really good model. And like different jurisdictions have done different things, right? Like in the US, we really have for the most part, we've launched Lab CFTC at the CFTC level. The SEC has FinHub, all the financial regulators have innovation offices, but there hasn't been like a statutory change to date. There are more and more proposals, but we haven't actually changed our laws. And for regulators to actually change anything, beyond a certain level that's within their discretion, you really need laws that change how those things work. So some jurisdictions like Bermuda, Abu Dhabi, Singapore, Japan have actually done kind of some bespoke digital asset related, and quite a number of others, Switzerland, Liechtenstein, have done some bespoke legislation. That's another approach. Maybe it's too early to have specific legislation for DeFi. It's not monolithic. There are lots of different pieces, but that's another approach to consider as well.
Marta, did you have anything you wanted to add there?
Sure, absolutely. Well, I think when it comes to thinking about regulating the space, the thing that it's really important to keep in mind, and again, I'm going to apologize for being extremely US-centric here, is really how you're going to regulate. It's something that is just fundamentally computer code, right? And so just to give you an example of something that I worked on, in 2018, the SEC brought an enforcement action against the founder of a decentralized exchange called EtherDelta. And so in trying to put its finger on what exactly EtherDelta had done wrong, in its order, the SEC made some pretty overbroad statements that seemed to suggest standards that would, in my view, definitely violate the First Amendment in the United States and would certainly be problematic for freedom of expression. So there, the SEC wrote basically that EtherDelta's founder had written and deployed code that he should have known would contribute to violations of the law, right? And the SEC also wrote that a person who was merely providing an algorithm could be basically liable merely for providing an algorithm, right? And so, leaving aside the other reasons that the SEC had for bringing the enforcement action, it was pretty concerning for me in my work with the Electronic Frontier Foundation on civil liberties that the SEC was sort of taking specifically the act of writing and publishing code that a programmer should have known would be used in a particular way. So we at EFF wrote a letter to the SEC about that and spoke with an SEC commissioner about it. And so I think it's really important to just keep that in mind, like specifically when you're thinking about regulations, what are we regulating and how? And I think it's very important that that doesn't come down to someone who is writing computer code.
Thanks. Yeah, I completely agree. I think this is one of the challenges with the nuance, right? When you can publish something openly and not anybody can use it, sometimes even, I'll point to a specific example. So Andre Christie, I think, from Urine Finance. So he built a whole bunch of open source smart contracts so that people could pool capital, and it would basically seek yield on the best DeFi platforms and provide a return for token holders, right? He published these smart contracts and people just started depositing capital into them, even when he was tweeting, and even put in the contract code itself, please don't use this, it's early, right? And then you'd ask the question, well, then why the hell are you publishing this? And the reality is, if we're to be very specific, the environment in a mainnet versus a testnet is actually quite different, because of the economic incentives, because of the technology itself, the level of decentralization is actually very different. So you can even write, and frankly, the tooling on Ethereum and many of these other networks is just not robust enough to do some of the things you want to do on these test nets. So you can go and test these, but they don't have the same, the variables aren't consistent across between a test net and a mainnet. So in his case in particular, I empathize because he's going, look, this is the fastest way for me to figure out if this stuff actually works. You know, I think this is a financial innovation. I'm publishing these things which could open up financial access for people. And the fastest way for me to do it is to put it to mainnet and hope nobody really uses it and only a handful of people that I know and trust use it. But that's just not the way this world works. And so I think, you know, I would say this is where sandboxing for me, and I have my own perspective, but where sandboxing I think gets really interesting, because if you could actually deploy things in a sandboxed way to be able to get that same experience and figure out if things work or not, with people knowing the risks and disclosures and that they're opting into, because that's exactly what happened. People knew these risks, but they did it anyways. And he has no control over it, because otherwise you would have, it wouldn't be decentralized, right? He would have complete backdooring into these smart contracts. And so it's this dichotomy. And I think this is where my personal opinion that regulators have an opportunity to create that environment. Lucia, go for it.
Yeah, I think you're making an excellent point there. And, you know, something akin to a like limited license framework whereby we can support people that are trying to create this innovation and give them that sort of way to publish their technology without necessarily entering the market per se. I think that's a really useful thing. I also am a big fan of Bermuda's approach to sandboxing. I think, you know, more countries can learn from that for sure, but it's also, you know, complemented by mechanisms that would incentivize platforms to provide a lot more information. I know the Monetary Authority in Singapore at one point or other decided to spend like a fair bit of resources in creating a unit that would review white papers and just like put out reviews of white papers that were being submitted into the market in Singapore. And then I know a couple of different countries that I've worked with are creating specialized units for specific applications of DeFi technology that they want to be able to offer citizens in some way. So I know a lot of countries, for example, that are thinking about pandemic recovery have been thinking about ways in which they could incentivize small businesses back into action, ways to encourage local populations to spend money on local businesses. And so thinking about incentive structures and models within the DeFi space proves to be a really helpful one. And so creating like a limited license to operate an incentive related project for economic recovery is something that I'm currently working on with another government. And so in thinking about these, like it is new technology. And, you know, I think Marta brought up something really special, which is that there is a lot of regulation already in place. Like, in fact, there's really a big opportunity in saying, you know, some forbearance in saying there's no new regulation needed. Let's look at existing regulation and then prune out what doesn't work and then start to look at creating new regulation. But then also at the same time, working with innovators proactively and saying, you know, we're going to create these limited license cases by which you can experiment with your technology in a low risk way or put it out, you know, in a pilot way alongside regulators. And I think historically speaking, regulation has always generally been reactive to what's going on in the market and then trying to catch up and trying to educate yourself. And so I think really changing that narrative and thinking about regulation as reg tech and bringing in that technology approach to it and thinking like, you know, an early stage innovator that's trying to put out a project works well in as a regulatory framework as well, and will assist in creating policies that are truly at least on par with the pace of innovation as it is, and will enable markets to remain competitive while still being observant and protective and informed on what's going on in what is an exceedingly fast-paced changing environment.
Yeah, Alex, I see you got your hand up. Thank you.
My manual high five.
Yeah, before I go to you, just one quick second. I want to, since we're getting near end of time, I want to remind people that specifically for the regulators and legislators in attendance, if you have a question, please pop it into the Q&A or raise your hand and we'll call on you. I do have one teed up, which I want to get to right after. That is quite specific. That was kind of forwarded my way. But Alex, go for, please add the commentary you
Sure.
wanted there.
And I'll keep it brief here, but I think everything that we're talking about specifically here ties in nicely to this sort of ethereal term of sufficiently decentralized. And if we all sort of agree that we're trying to get to this point that is sufficiently decentralized to be outside of certain regulatory regimes, it's basically impossible to get there on V1. And and it would be irresponsible to do that on V1. You need the ability to pull, you need the ability to change. It's like creating a circular Excel model and then locking it and never being able to edit it when it refs out and blows the hell up. And you basically, you need to create the ways that we can have those circular iterations and we can have that very tight governance, but with all of sort of the simulations of how this would happen in the real world. And so rather than creating this kind of catch-22 where you cannot become sufficiently decentralized because you're in violation of securities laws and blah, 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 in order to get to that point, then I think this sandboxing approach is a very nice way to tackle that middle part or that initial part to be able to, assuming we're aligned on the goal of creating things that are sufficiently decentralized, which may be another conversation entirely, to be able to sort of take existing regulations, isolate specific gaps in those, and then try and apply our regulatory guidance and malleability to fill in specific gaps is a nice way to kind of conceptualize it, I hope.
Yeah, and this is a great segue, actually. It wasn't the question I was going to ask, but I think it's an important one that we did have in the list here. And I'd like to get everybody's perspective is, we know that there's a lot of nuance to the term decentralized. What do you think are some of the important factors to consider when we're considering something sufficiently decentralized? Maybe who wants to take this as a first stab? Alex, are you open?
Always, my friend. Yeah, I mean, I think there's, and I'll be brief and I'll let the rest of the panel chime in. Yeah, I think there's a certain amount of education required, and I'll tie it back to my comments from a minute ago as well. Of there's a certain point where you kind of let this out into the world, and some of it, is basically smart contract related and kind of the clawback rights and the admin super keys and all of those things that are there, and they're not secret, but they don't match up with sort of what the public perception of a project is or a decentralized project is. And a lot of that is, you mentioned venture capitalists and kind of the early stage investors and the foundations and the project governance and the people who have gotten it through those iterative phases where it really needs to get to be sufficiently decentralized, but they still have that level. And a lot of that is tech and it's black and white, and that is something that can be relatively black and white. And tech is always advancing. You can always find new creative ways to assert control over a project. But those backdoor keys and kind of the super skeleton admin right to move assets around, I think is a key part of it. While acknowledging that having the ability to reset a system when something goes really wrong is also good. But that ability might need to be decentralized itself. So when you have the governance that kind of governs how those things work, and it gets into a bit of it's turtles all the way down at some points. But those are some of the things that I always think about. There's very obvious ones where it looks like it's perfectly decentralized, even when there are governance tokens out. But there's an ability for a super user or a one group to change to massively change everything.
Yeah, maybe I'll add some context to at least the way that I've been thinking about this too, is that it's very similar to what you were thinking about, or what you described, you and Lucia, about the different risk buckets. Is how does the decentralized nature or the various actors involved impact these risks? So, specifically, does one or more entities, are they more likely to collude and be able to control the operations of a smart contract or the private keys or asset issuance? Is there a likelihood of financial benefit, or even bringing it to the existing securities legislation like this common enterprise? I mean, I think what you were mentioning and what we're starting to see, at least some rumblings of discussion around a safe harbor, where it would probably be irresponsible for a project to launch, and we've seen some of these projects launch and accumulate massive amounts of capital to the tune of billions of dollars in capital, where we're seeing this experiment in real time, where some of the groups are launching things anonymously and largely decentralized, and even the control is split amongst a handful of developers and a handful of people that are governance token holders that can vote on whether these contract updates even go live and into production. But that's still a pretty small set of people, right? So is that, sufficiently decentralized? If it is too decentralized, then it may actually be impossible to fix something that could be broken. And then that could actually have huge financial harm. And I think this is the risk that you run when you put people into this bucket we're in right now, where it's either you be centralized and regulated, essentially, or decentralized and anonymous or pseudo-anonymous, right? And there should be probably this middle ground where you can have this safe harbor and ability to experiment and disclose some of the risks to people that are willing to take those risks, and then progressively move towards that world that people are looking for, which, can be quite disruptive to some industries. So I think that's why it's a challenge, but also to the point that Lucia made, has potentially huge implications for financial inclusion and leveling the playing field in terms of financial access, as well as efficiency gains that could happen as a result of the more peer-to-peer nature of these technologies. Lucia, did you have your hand up for commentary?
Yeah, but I know Jeff has to go. So if he wants to take a stab at this first, and then I'll go in right after.
Sure.
Yeah, I mean, I think that, this whole question of what is sufficient decentralization and for what purpose, I think we have to ask ourselves, why are we even asking the question? So, in the US, that can be very significant, in a jurisdiction where, the degree of decentralization or not can affect the question of whether or not something is considered an investment contract or an offer or sale of securities. And, to the extent, my understanding is that, Canadian securities laws, have, and I believe Taiwan is the other jurisdiction, have a number of parallels to the US. So maybe, those are the three jurisdictions where that's the case. But in a lot of jurisdictions, the amount of decentralization or not, is really unrelated to, this whole question of securities laws. And those other jurisdictions have securities laws. In Europe, it's a financial instrument, but it really has to do with kind of, I think, a lot of people's visions around. There was the internet, and then there's Web 2.0, and Web 2.0 is clearly dominated by Google, Facebook, Apple, Amazon, their kind of peers, kind of around the world. And so people thinking, how can we have, based on, blockchain and crypto assets, which are the internet of value, can you have new business models that create new opportunities? So I think the reason that people are decentralizing things is not just because of, in some cases maybe, but, it's not just about, complying or not complying with securities laws that may not even be the same in other jurisdictions. It's really trying to innovate these new business models that, from the perspective of a lot of innovators, provide the benefits to the users and the governance to the users and the economic benefits to the users, as compared to kind of Google or Facebook or Amazon, where, one's perception might be that, the users are the product, and then the enterprise value goes to kind of the company itself. So I think, what is sufficiently decentralized, if it's what is sufficiently decentralized that the SEC might determine that it's not an offer sale of securities. So far, we know Ethereum is the only thing that the SEC has ever said is sufficiently decentralized. Now, interestingly, Tether, which is a stable coin, right? The CFTC said last week that that's a commodity and not a security. So we're learning about these things. But I think even this question of what is sufficient decentralization, we'd say, why are we even asking that question? maybe what does the consumer want? How do you protect the consumer, and what are the benefits? And with that, thanks everybody. I apologize. I have to go a few minutes early. That's been a great discussion. Thanks so much,
I
everybody.
appreciate you taking the time to be on the panel. So thank you very much. Lucia, do you want to wrap it up for us?
Yeah, sure. So I was just thinking more back into Alex's theory of buckets. I think about decentralization and how decentralized something might be, and also this category of buckets. And I look at, the actual service that is being offered, what is the function of it? And, is it peer-to-peer? Is it going through intermediaries? Realistically speaking, as we stand today, DeFi does require the use of intermediaries. There's just simply no way around that. And so I think, we have to be realistic about where we're at with the technology before jumping and saying it's a completely decentralized space. It's super inclusive. It's not. There are so many services and products within the DeFi space that are not inclusive at all, and also that require, a lot of diligence, that require access to certain technologies, access to assets that already exist, which Alex and I were talking about earlier. And then, so looking at like the product itself and its function, and what are the steps in order to access that service will give you a great indication of how decentralized something might be. Looking at how much trust might be minimized in order to execute a particular action. How is settlement taking place? Who are we putting this trust in? And all of this process from end to end, and looking at the protocol itself, and what happens if there's an issue within the protocol, et cetera, and looking at custodial design and saying, okay, well, this service that I'm going to use is non-custodial, it is custodial. That will give you an indication of how decentralized the service might be, and what happens when there's a need for password recovery, and what happens when there's an issue, and who deals with that issue. Is there a customer service number you can call, or is there not? Because that's a very easy indicator of how decentralized something might be. And then finally, I think looking at how programmable is it, how open sourced is it, and how many components are there to a particular solution. If you are looking at a solution that has these integrated components that can be easily replaced when there's a fail, then that's something that we're really excited by, because it means that we're not relying on a single entity for success. And I think NBA Top Shots taught us that quite well, which is this notion of, people thought they were buying an asset, and in reality, it was a centralized offering, and it relied on, Dapper Labs maintaining liquidity, and it relied on their technological capacity. And so, in reality, it looks a little bit more like a security than an asset. So really looking at how composable the architectures within the DeFi space can also give us a good indication of this decentralization. So I look at those categories, and those are the questions that I ask myself, although I really do agree with Jeff's approach of also looking at risks and assessing how risk might impact the user would also be a good way to assess decentralization.
Yeah, I think that's a great summary. There are so many different pieces to this, and even one of the last questions that I had as a result to ask was, more specific even to staking that the regulators are looking at, and what are the risks there. And I think we've touched on a lot of them. I mean, a lot of them have to do with protocol risk and smart contract risk and the token economic risk. Is it a sustainable, or is it an inflationary type risk? And then any other custody or counterparty or governance risks as a result of the protocol. So yeah, I think we're seeing with DeFi, I think the general summary probably here would be that a lot of the risks are actually stuff we already see in traditional financial infrastructure, but then now we're seeing some new ones because of the composability and how many various actors can be involved all around the world in participation in this, which presents unique opportunities, but also unique challenges in terms of governance and risk and regulatory oversight. So I wanted to thank all of you very much for joining us on the Canadian Blockchain Consortium DeFi panel. I hope this was valuable for the regulators and legislators tuning in, as well as all the other people that tuned into the broadcast. Thank you very much, and I'm sure we'll be rounding up another one. Kalea, I'm going to hand it over to you to wrap up, but thank you everybody for attending.
Thanks, Eric, for hosting. And thanks to the rest of the panelists. I thought that was a fantastic discussion.
Oh, maybe Kalea missed me. In any case, what we're going to do is wrap up stay tuned to the Canadian Blockchain Consortium Twitter, website, LinkedIn, email newsletter. We'll be announcing. We're trying to run these quarterly to try and keep a regular cadence. We'll be looking for feedback. So for the regulators and legislators in attendance, we'd love your feedback to see what is useful, what is not, any future topics so that we can bring together some more excellent panelists together who have both a local and global perspective on what's happening around the world. So with that, thank you very much. And everybody enjoy the rest of your day. And thank you, the panelists, again for your time. Appreciate it.
Thanks, everyone.